please do not believe their lies. They're all telling you to be smart with your money. Buy into the S&P 500, buy into index funds, and just buy even more if it dips. Whenever the price goes down, it's an opportunity to buy even more. And they're showing this chart to justify that reasoning. And it seems to make sense. If you just wait for long enough, you will make money. This is the S&P 500. And if you buy more when it dips, that's even better. Then you get even more return going forward. It seems like a logical argument. Yet it's still a lie, because what drives up the S&P 500 is the same thing that drives up the gold price over the year. And that's the same thing that drives up house prices over the year. What's actually going on here is not that stocks become more valuable or that this piece of shiny rock suddenly is so much better 100 years from now compared to today. What's actually happening is that the denominator, the US dollar, that's going down over time. Thus, prices go up, measured in US dollars. The monetary base expands on average by 6.8% per annum. That's how quickly USM2 rises. Now, there are many reasons why the money supply is going up. For example, the government can just borrow more money, can issue bonds, and that way expand the monetary base. Or people can just borrow themselves, right? They can buy a house, get a mortgage. That mortgage money, that's completely newly created money. There is fractional reserve banking. Banks don't need to have the capital that they're lending out. They just create the capital out of thin air. Now, there was a massive jump even in the base money supply during the global financial crisis. And that's why Bitcoin got created. The very first block that Satoshi Nakamoto started, it had an inscription with a reference to a New York Times article. And that New York Times article talked about the bailout in Germany of the banks with newly created money. So Bitcoin was created as the hard money. And of course, today it's harder than it has ever been. The Bitcoin inflation rate is at 0.8% per annum, and that will drop to 0.4% per annum. And again, that compares to the fiat currency base expanding by 6.8% per annum. So even at the current inflation rate, our expected US dollar gain in Bitcoin should be at least 6% per annum. And of course, over the years, Bitcoin did much better than that. This is the Bitcoin price relative to the money supply. We can see with every single cycle how Bitcoin outperformed the monetary base expansion. In the last cycle, it was 71%. Each of those cycles lasts roughly 4 years. Now, clearly, with every cycle, we've got diminishing returns. So we make less relative to the monetary base expansion. Still, it is one of the hardest monies. It's got a lot of volatility. It does have its drawdowns. But we can make the same argument for Bitcoin that we can also do for the S&P 500 or for gold or for property. If we fall hard enough, and we believe that the asset will stay around because its supply is limited, then at some point, simply because of monetary debasement, we should recover again. And so that's the lie of this chart of the S&P 500. Too many people are very opinionated and they have their favorite asset. Be this stocks, be this precious metals, be this property. Most people have one thing that they put most of their money in. For some people, it is even Bitcoin. Now, this is the Bitcoin strategy channel, but that does not mean that I've got the vast majority of my wealth in Bitcoin all the time. I like to be opportunistic. I want to buy the asset that's currently cheap. I want to sell the asset that's currently expensive. And the best way to figure this out is to look at relative valuations. How is an asset class relative to the monetary base long-term performing? I'm actually not bullish on Bitcoin in the near term. This is the realized price, the average cost basis of the market. And every time Bitcoin tended to fall 10 to 20% below the realized price before we turned around from the bear market. That realized price is currently at $53,000. So I do expect us to fall below 50K before we turn around. Now, nobody knows if this whole model will continue to work in predicting Bitcoin prices, but still, I think it's a useful reference point. Another way to see the same thing is to look at the net unrealized profit or loss. In other words, the average Bitcoin investor had to be in unrealized losses before we actually turned around. And we are not there yet. I have my strong doubts that the S&P 500 is now the best place to park our capital, because this year, that's the S&P 500 relative to the monetary base. It's a long-term chart. It's 66 years of data. The dotted line shows the average ratio of the two. And we can very much make the argument that the S&P 500 just trades around this equilibrium. This year was the dot-com crash. This year was the global financial crisis. Bitcoin got created over here. Since Bitcoin's creation, risk on assets tended to expand. So we never really experienced a real crisis in the last 17 years. And now we are at dangerously high levels. There is a very good chance that the S&P 500 falls by more than 50% from here. And then we just get back to the equilibrium. We are not even overshooting that equilibrium. Still, we want to be diversified. And my personal approach here is to try to be over-invested in the asset class that seems comparatively cheap and be under-invested in the asset class that seems to be expensive. Now for the stock market, I want to buy the best, right? Whatever that means. In the crypto market, I'd rather have Bitcoin exposure than a random altcoin mix because Bitcoin tends to outperform most altcoins. In the stock market, we've got a very similar setup, as in the larger stocks tend to outperform the smaller stocks long term. Since we need to have some exposure to the stock market just to be diversified, it probably makes sense to just buy the largest stock. What we've got over here, that's the S&P 1, so just the largest stock at each point in time, versus the S&P 500. That's the orange line over here. If you just bought the largest stock and you held this for the entire year and then you rebalance again 1 year afterward and you do this year after year after year, you made much more money compared to the diversified S&P 500. The largest stock made on average 17.5%, the S&P 500 made only 10.5%. And those 7 percentage points difference every single year, that makes a difference of almost 10x over the course of those 36 years. So this does matter. Now the largest stock right now is Nvidia. And so that then begs the question, if currently valuations are that high and especially tech stocks are that expensive, does it really make sense to have a vast majority of our stock allocation in something like Nvidia, which is the pure representation of the artificial intelligence bubble? Let's see how much risk we really take here. Let's take this bear market. So we had the dot-com crash and we had the global financial crisis. So the S&P 500 over those 8 years lost 73% versus the monetary base. And then it took another 17 years just to get back to where we've been before. Again, relative to the monetary debasement. In other words, just always buying the S&P 500 and not buying the thing that's cheap at a time that can be very suboptimal, right? We can lose more than 70%. It can take a very long time to just recover our losses. It is smart to be allocated to the cheap asset class at a given point in time and to be not too opinionated about one particular asset class, to always just buy Bitcoin, to always just buy stocks, to always just buy property. We have to be opportunistic, at least if we want superior returns. Now let's see how the S&P 1 versus the S&P 500 performed during that crash. Is it really that much more risky to buy only one stock versus a diversified portfolio? Or in other words, should we own the S&P 500 for diversification? In the crypto market, we already might have a hunch here, right? Even in a bear market, Bitcoin tends to outperform most altcoins. But is that true for the stock market as well? Is the largest stock really the best during a crash? Does it make sense to now buy Nvidia stock since tech valuations are so high? Here is the data. So here we've got the annual returns. 2000, 2001, 2002 have not been great. Then we had a few positive years. Then we had 2008 with the global financial crisis. Let's have a look at those years, 2000 to 2008, in relative performance. That's the chart. The delta in 2000 was pretty much zero. In 2001, the S&P 1 did slightly underperform. In 2002 as well. But then subsequently, it outperformed quite a bit again. And even 2008, where we had the global financial crisis, that was an outperformer for the S&P 1 versus the S&P 500. So on average, over those years, even though we had been in only one stock, the largest stock, the most hyped stock, the stock that everybody was talking about, even though we had that allocation, we still did better during that crash just owning the largest stock compared to owning all of the stocks. So in the stock market, we've got the exact same mechanism that we already have in the crypto market. There is this one winner that tends to accumulate most profit, and then there is the big long tail that tends to underperform, and that even underperforms in a bear market. So since right now, the best largest stock is Nvidia. Let's have a look at Nvidia in more detail. This is the Nvidia price relative to the S&P 500. Of course, it outperformed long term, but where is it right now? It barely outperformed over the last 2 years, only by roughly 6 percentage points. And on average, the larger stock tends to outperform the S&P 500 by 7 percentage points per year. So we should actually see on average 14% of outperformance. We only see 6. So the last 2 years have not been that great for the Nvidia price development. Nvidia is not necessarily that expensive. I would make the argument that as an allocation to the stock market, Nvidia is probably the best bet right now. And I'm saying this because I think this is one of the least risky artificial intelligence stocks. The riskier places in AI is the application layer, not the hardware layer. So for example, Anthropic and OpenAI. The reason why those are more risky is because they monetize their current edge in the model versus what's currently freely available. So we've got the free DeepSeek that does have a level, but it's not as good as, say, Fable 5, right? The leading model of Anthropic. Now, let's say artificial intelligence model development does not progress as fast anymore as it used to be. Let's say the next model after Fable 5 is only barely better compared to Fable 5. And let's say in the same time frame, DeepSeek catches up. And so the difference between the free and the very expensive model shrinks. If that's what's going to happen, if the marginal utility, the marginal development of the frontier models tends to decline, this is a huge problem for Anthropic or for OpenAI, because then they can't monetize that well. Then there will be more replacement with the free models. Now that scenario is not that much of a problem for Nvidia. It might even be good for Nvidia, because let's say those big buyers of Nvidia chips suddenly weaken, and then everybody buys their own GPUs to run those models locally, or a lot of small companies run those chips. The small companies have less of bargaining power to buy those chips. In other words, Nvidia can potentially create larger margins. So that's a scenario, a slowdown of progress of AI simply because of technical constraints or because of a lack of creativity. That's at least not going to actively harm Nvidia, but that's definitely going to harm Anthropic and OpenAI, etc. So I think Nvidia is less risky compared to the application layer, compared to the model layer. Now, there are no stocks for OpenAI and Anthropic available yet, but I don't think they would be the best investment. I think Nvidia, given also that it hasn't outperformed that much in the last 2 years, is the better bet. And again, it is the largest of the stocks, and the largest of the stocks tended to outperform quite consistently, actually, over the years. So while those growth rates in revenue for the application layer is very impressive, higher growth rates also mean very high valuations. Investors extrapolate what will be the revenue 1, 2, 3, 4 years from now. And if those expectations don't turn into reality, prices correct extremely quickly. Here's Nvidia relative to the Nasdaq 100 over the last 2 years that even underperformed slightly. So again, I'm not saying that we need to have a strong allocation towards stocks. I'm just saying that for the allocation in stocks, right, we want to be somewhat diversified. Nvidia is probably one of the better bets. The same way how Bitcoin is probably one of the better bets within crypto. But I do think it's probably better not to be too much invested in stocks, simply because of their historical valuations. A lot of the capital is now captured by the stock market, and that capital might rotate into other asset classes later on. And one of those asset classes that has recently suffered is, of course, Bitcoin. It has come down by 50%, and I do think at some point we will see an all-time high. The question is only when. In the short term, I am not bullish. As said, I do think we need to be in net unrealized losses first. But the wrong answer is to shift Bitcoin money now into Nvidia stock, especially if you use fancy products like perpetual futures, because this becomes now more and more popular within the crypto space, right? Just get exposure to the stock market by using platforms like Binance or Hyperliquid to actually buy Nvidia stock via leverage. The problem is that that leverage is very expensive. On Hyperliquid, funding Nvidia stock costs 15% per annum. On Binance, it's 11% per annum. That takes away most of our expected long-term return. Instead, we can take those high funding rates on places like Hyperliquid and actually make money risk-free from that. That's currently what I do. I do interest rate arbitrage. So I bet on falling prices of those popular stocks on platforms like Hyperliquid and then get my 90% or 46% or 36% per annum. And at the same time, I buy the asset in my brokerage account so that I am price neutral and just collect those funding rates. That's what I've been doing for the last month. I'm very happy with the returns. This is what my mixed portfolio has done so far. 57% APY on equity. But of course, this takes a bit of effort. We have to learn how those platforms work, and this is not completely hands-off, but it has comparatively low risk. But I think it's a mistake not to learn those things. Of course, you can ignore everything that has been said here. You can be lazy and just buy into your favorite asset class all the time and forget about everything. However, it's not optimal. And the difference between buying the cheap asset and buying the expensive asset at a given point in time, it can make a delta of more than 10x over 30 years or so. Learning how to properly invest long-term does pay off. I'm not talking about trading small meme coins. I'm not talking about trading small stocks. I'm talking about the right allocation per asset class and picking the right asset within the asset class. Doing that over the long term, we still can have a somewhat diversified portfolio, but have way better returns, a much better risk versus reward. And that's really what matters. We want to be in the investment game. We don't just want to be in US dollars, but we don't just want to be in one asset class just because it's convenient. And so down below in the pinned comment, you will find a link to this page. This is a free report that you can download. It's a framework of what is worth holding and what should rather be avoided, how to make the decision, how to make the rebalancing properly. It's completely free. It can be sent to your email address. Alternatively, if you've got Telegram, you can also get that directly via the app. You can also scan the code if you've got Telegram. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.